In financial markets, the most important events rarely arrive with sirens, headlines, or official announcements, because by the time something is obvious enough to be discussed publicly, it has already happened quietly in the background. And this is why rumors of a leaked memo from a major institution like Morgan Stanley resonate so deeply with investors, even when no document is confirmed. Because markets understand instinctively that institutions do not wait for permission to move. They move first, justify later, and explain only if forced, and what matters is not whether a memo exists, but whether behavior has changed in a way that contradicts public narratives. For years, silver has occupied a strange psychological space in global finance, respected in theory as money, dismissed in practice as an underperforming commodity, and tolerated by institutions primarily as a liquidity tool rather than a conviction asset. And this contradiction becomes most visible during periods of stress because when markets are calm, silver is discussed in terms of inflation, industrial demand, and monetary history. But when liquidity tightens, silver is treated very differently, not as protection, but as inventory, something to be mobilized, sold, or hedged in order to preserve balance sheet stability. To understand why a bank like Morgan Stanley might aggressively reduce silver exposure, you must first discard the retail investor's mental model, which assumes that selling implies bearish belief. Because institutions do not operate on belief. They operate on constraints, and constraints are defined by funding costs, regulatory capital, counterparty exposure, and internal risk models that most investors never see. And when those models change, behavior changes instantly, regardless of long-term outlook. Banks exist to survive volatility, not predict it. And survival in modern finance depends on liquidity, not valuation, because liquidity determines whether obligations can be met tomorrow morning, not whether an asset will be worth more next year, and when liquidity becomes uncertain, assets that trade in leveraged markets become liabilities, even if their long-term story remains intact. Silver is one of the most leveraged markets in the world relative to its physical size, with paper claims vastly exceeding available metal, and this structure works as long as confidence in settlement remains unquestioned. But when volatility rises, margin requirements increase, repo financing tightens, and collateral efficiency declines. Leveraged exposure to silver becomes dangerous not because silver is bad, but because it is volatile, and volatility consumes capital. From the perspective of a risk committee, silver exposure is not evaluated emotionally, historically, or ideologically, but mathematically. And if internal models indicate that silver's contribution to portfolio volatility has crossed a threshold, selling is not optional, it is mandatory, because banks do not get rewarded for being right in the long run if they fail in the short run. This is why institutional selling often appears sudden and irrational to outside observers. Because the decision was not made when selling began, it was made weeks or months earlier when funding conditions shifted, stress tests were updated, and worst-case scenarios were rerun under new assumptions. And by the time execution occurs, the outcome is already locked in. The idea of a leaked memo becomes compelling precisely because it aligns with how institutions actually function internally, where risk is communicated through technical language, numerical thresholds, and contingency planning rather than dramatic declarations. And if such a memo existed, it would not say, sell silver because silver is doomed. It would say something far more mundane and far more dangerous, like reduce exposure to assets with elevated liquidity and margin sensitivity under stressed funding conditions. That kind of language does not sound dramatic, but its consequences are. Because it triggers mechanical selling across desks, strategies, and portfolios, regardless of personal conviction, and once selling begins at scale, it feeds back into price, volatility, and margin requirements, creating a self-reinforcing loop that looks like panic from the outside, even though it is rule-based on the inside. What makes this moment particularly important is the broader macro backdrop in which it may be occurring. Because global liquidity conditions are tightening, dollar funding remains structurally scarce outside the United States, repo markets periodically flash stress signals, and central banks are attempting to balance inflation control with financial stability. A task history suggests is rarely successful for long, and in such an environment, banks become hypersensitive to any exposure that could amplify losses during a funding shock. Silver's dual role as both an industrial input and a monetary asset complicates its behavior during these phases, because industrial demand supports long-term fundamentals, while monetary positioning amplifies short-term volatility. And when volatility dominates, institutions respond not to the future, but to the present. This creates the paradox that confuses most investors. Silver can be strategically valuable and tactically dangerous at the same time, and banks are paid to manage tactical danger, not to champion strategic narratives. If Morgan Stanley is reducing silver exposure aggressively, the most important question is not whether silver's long-term case has failed, but whether the institution perceives elevated systemic risk elsewhere that requires balance sheet protection now, because banks rarely sell what they expect to outperform unless they are prioritizing survival over return. History supports this interpretation because during every major liquidity event of the last half-century, from the 1987 crash to the 2008 financial crisis to the March 2020 panic, silver was sold aggressively in the initial phase, not because it lacked value, but because it was liquid enough to be sold, volatile enough to reduce quickly, and widely held enough to generate immediate cash. And only after central banks restored liquidity did silver recover and outperform. This pattern is not intuitive, but it is consistent, and ignoring it leads to repeated confusion, frustration, and misinterpretation of institutional behavior, especially among investors who expect silver to behave like an insurance policy rather than a market asset embedded in a leveraged financial system. The uncomfortable implication is that institutional selling, even if it looks like surrender, is often a signal of stress elsewhere, not a verdict on the asset itself, and when multiple institutions act similarly around the same time, it suggests a shared recognition of rising systemic risk that has not yet become visible to the public. This is why the rumor of a leaked memo matters, even if no memo ever surfaces, because it reflects a deeper truth about how information moves in financial systems, where behavior leads narrative, execution precedes explanation, and clarity only arrives after positioning is complete. And this brings us to the next layer of the story, because selling does not occur in a vacuum. It is funded, hedged, and transmitted through the plumbing of the financial system, particularly through repo markets, collateral chains, and short-term funding mechanisms that determine which assets are safe to hold and which are not under stress. In part 2, we will go inside that plumbing and explain how repo markets, funding stress, and balance sheet constraints force institutions to sell silver, sometimes violently, even when they believe in it long-term, and why those signals often appear weeks before the public notices anything is wrong. Liquidity stress, repo markets, and why selling becomes mandatory. To understand why institutions like Morgan Stanley might suddenly and aggressively reduce silver exposure, you have to move beyond charts, headlines, and asset narratives, and instead step into the invisible infrastructure that actually determines survival in modern finance: liquidity, collateral, and short-term funding. Because no matter how sophisticated an institution appears, it ultimately lives and dies by its ability to roll funding every single day. And that ability is governed not by opinion, but by the repo market, the most critical and least understood mechanism in the global financial system. The repurchase agreement market, or repo market, is where banks, hedge funds, dealers, and large institutions borrow cash overnight by pledging high-quality collateral, typically U.S. Treasuries, in exchange for liquidity. And this market is not optional plumbing. It is the bloodstream of modern finance, because trillions of dollars in positions, derivatives, and market-making activities depend on continuous access to cheap, reliable short-term funding. And when repo conditions tighten, the system does not gradually adjust, it snaps. In calm periods, repo is invisible, stable, and boring, which is exactly how it is supposed to be. But during stress, repo becomes the first place where trust fractures. Because repo is not just about money, it is about confidence in collateral, counterparties, and tomorrow's liquidity. And when that confidence weakens, institutions do not debate philosophy, they cut risk. This is where silver becomes vulnerable in ways that most investors never anticipate. Because while silver is a physical asset with long-term monetary and industrial value, most institutional silver exposure exists inside leveraged structures: futures contracts, options, swaps, ETFs, and structured products, all of which require margin, collateral, and continuous financing. And when funding costs rise or collateral haircuts increase, the carrying cost of silver exposure rises sharply. From a risk desk perspective, this is not a discussion about whether silver should be worth more in 5 years, but about whether holding silver exposure today consumes too much balance sheet capacity relative to its expected return under stressed conditions. And when that calculation turns negative, selling is not discretionary, it is compulsory. What most people fail to grasp is that modern financial crises are not driven by insolvency first, but by illiquidity, because solvent institutions can still fail if they cannot fund themselves overnight. And history repeatedly shows that liquidity crises force selling of assets that are fundamentally sound simply because they are liquid enough to be sold quickly. This is why the phrase panic selling is misleading, because from the outside it looks emotional, chaotic, and irrational, but from the inside it is often mechanical, rule-based, and pre-authorized, triggered automatically when certain funding, volatility, or exposure thresholds are breached. And once those triggers fire, human judgment largely disappears from the process. If Morgan Stanley's internal risk models flagged silver exposure as disproportionately sensitive to a tightening liquidity environment due to volatility spikes, margin expansion, or correlation changes, then reducing that exposure would be the rational response, even if the institution believes silver will be much higher in the long run, because survival is always prioritized over conviction. This dynamic is intensified by the fact that silver is often used as a hedge against monetary instability, which ironically makes it more likely to be sold during early stages of that instability, because when markets sense stress, correlations move toward one, funding costs rise, and hedges become sources of liquidity rather than protection. And this paradox is one of the most painful lessons for investors who believe hard assets automatically protect them during crises. Another layer that matters is regulatory capital, because banks are not free to allocate capital. However they choose, they are constrained by capital ratios, stress tests, and regulatory frameworks that penalize volatility and reward balance, sheet efficiency, and when volatility rises across markets, assets with higher risk weightings consume more capital, forcing banks to rebalance, not because they want to, but because they must. Silver, due to its price volatility and leverage, often carries an unfavorable capital efficiency profile during stressed periods, making it an easy target for reduction when capital preservation becomes paramount. And this has nothing to do with belief or manipulation. It has everything to do with survival math. This is why institutional behavior often leads price, rather than follows it, because risk desks respond to funding conditions, not market narratives. And by the time price declines become visible to the public, selling has often already occurred or is well underway. It is also why rumors of internal memos gain traction during these phases, because while the public sees price moves, institutions experience internal communication, emails, risk notices, margin updates, and exposure limits that never become public but drive behavior decisively. And whether or not a specific memo exists is less important than the fact that such communication is routine during periods of tightening liquidity. History provides uncomfortable confirmation of this process because during the 2008 financial crisis, silver collapsed alongside equities in the early phase, despite being a monetary metal, as institutions sold anything that could raise cash. And it was only after central banks flooded the system with liquidity that silver began its explosive move higher. And the same pattern repeated in March 2020, when silver crashed violently before rebounding once funding markets were stabilized. These episodes were not failures of silver's long-term thesis. They were demonstrations of how liquidity dominates markets in the short term. And investors who misunderstand this dynamic often exit at precisely the wrong moment, mistaking forced selling for fundamental invalidation. The critical insight is that when institutions sell silver under liquidity stress, they are not saying silver has no future. They're saying we cannot afford this exposure right now. And that distinction changes how the signal should be interpreted because it shifts the focus from asset value to system health. If multiple institutions are behaving similarly, reducing exposure to volatile, leveraged assets, it suggests that stress is not isolated but systemic, and that the plumbing of the financial system is under pressure in ways that are not yet visible in mainstream indicators, because liquidity stress always appears first in places most people are not watching. This brings us to a deeper and more unsettling implication, because if silver selling is driven by funding stress rather than belief, then the real risk is not that silver fails, but that the system reaches a point where forced selling exhausts available liquidity, creating conditions where central banks must intervene once again to prevent cascading failures. And that is where the story moves beyond Morgan Stanley, beyond silver, and into the broader question of what happens when repeated liquidity interventions become the only thing holding the system together. Because history shows that each intervention stabilizes the present at the cost of amplifying future instability. In Part 3, we will step back into history and examine why silver always behaves this way during liquidity crises, how 2008 and 2020 reveal the same pattern playing out again, and why what looks like surrender today may actually be positioning ahead of a much larger structural move. Why silver always breaks last: history, liquidity cycles, and the setup. Before the surge. To understand why silver repeatedly collapses during moments of financial stress, only to later outperform nearly every other asset, you have to stop viewing silver as a trade and start viewing it as a diagnostic tool for the global monetary system, because silver does not simply reflect supply and demand. It exposes when liquidity is real, when it is artificial, and when confidence in paper systems begins to fracture. History shows that silver almost never leads during the early phase of a crisis, and this is not a flaw, it is a feature. Because silver sits at the intersection of two worlds that behave very differently under stress: the world of monetary assets and the world of industrial commodities. And when liquidity tightens, both sides of that identity work against it at first. During the initial stages of a liquidity crisis, institutions do not ask which assets will survive the next decade. They ask which assets can be sold immediately to raise cash without completely breaking markets. And silver, unlike real estate or private credit, is liquid enough to be sold, volatile enough to release margin, and small enough relative to global markets that it can absorb forced flows without triggering instant intervention. This is why in 2008, silver fell over 50% even as the global financial system was unraveling. And why in March 2020, silver collapsed in days during the pandemic panic, not because silver was failing as a monetary hedge, but because it was being sacrificed to stabilize balance sheets. And in both cases, that selling had nothing to do with silver's long-term value and everything to do with liquidity triage. Once you understand this, silver price action stops being confusing and starts becoming predictive because silver does not signal optimism. It signals stress resolution, and it only begins to move decisively higher after three conditions are met. Forced selling is exhausted, funding markets are stabilized, and confidence in paper promises begins to erode again. In both 2008 and 2020, the turning point for silver came not when fear peaked, but when central banks intervened aggressively, flooding the system with liquidity, suppressing interest rates, and signaling that monetary debasement was no longer a risk but a policy choice. And once that signal was clear, silver transitioned from a liquidity source into a monetary escape valve. What makes the current environment different is that central banks are far more constrained than they were in prior cycles, because inflation is no longer theoretical, debt levels are far higher, geopolitical fragmentation has reduced policy coordination, and trust in institutions has eroded across both political and economic lines, meaning that the traditional playbook of unlimited liquidity injections carries much higher credibility costs. This matters enormously for silver, because silver thrives not simply on money printing, but on distrust of the system doing the printing. And when credibility weakens, the demand for physical settlement increases, which directly undermines paper suppression mechanisms. Another critical historical insight is that silver never moves in isolation. It moves in sequence. And that sequence is remarkably consistent across decades. First, funding stress appears, then risk assets sell off, then safe havens rally briefly, then everything liquid is sold to raise cash. And only after that does silver begin to separate from the pack, because only then does the market start distinguishing between assets that represent claims and assets that represent ownership. This is the phase where institutional behavior becomes deeply counterintuitive to the public, because while retail investors are still focused on price weakness, institutions begin accumulating quietly, not through headlines, but through strategic positioning, physical contracts, and long-duration exposure that does not require constant margin maintenance. This is also why rumors of capitulation, surrender, or exit by major banks should not be taken at face value, because history shows that visible selling often coincides with invisible accumulation elsewhere, and that divergence is where the largest opportunities and the greatest risks are created. Another layer that cannot be ignored is the structural imbalance between paper silver and physical silver, because for decades, the market has operated on the assumption that paper claims would never demand physical delivery at scale, but that assumption is increasingly fragile as industrial demand rises, inventories tighten, and geopolitical risk incentivizes stockpiling rather than just-in-time sourcing. When liquidity stress forces selling of paper silver while physical demand remains resilient or even increases, the divergence between price and availability widens, and this divergence is unsustainable over long periods, because eventually the market must reconcile price with reality, and when that reconciliation occurs, it rarely happens gradually. This is where silver's volatility becomes an advantage rather than a liability, because suppressed volatility stores energy, and when the release comes, it tends to be violent, rapid, and psychologically destabilizing, particularly for institutions that believe suppression could continue indefinitely. What history teaches is not that silver always wins, but that silver always tells the truth eventually, and that truth is revealed not in calm markets, but in moments when confidence breaks, rules change, and previously unthinkable actions become acceptable, because silver is not just traded, it is remembered, and that memory resurfaces whenever systems appear fragile. If institutions like Morgan Stanley are reducing visible silver exposure now, the critical question is not whether silver is finished, but whether the system is entering the exact phase where silver is routinely mispriced, misunderstood, and misinterpreted, because that phase has historically preceded silver's most powerful moves. This brings us to the most important insight of all. Silver does not need belief to rise, it needs pressure, and pressure is building not in price charts, but in funding markets, supply chains, and institutional behavior that suggests the margin for error is shrinking rapidly. In Part 4, we will bring everything together and examine what happens if this pattern completes, what capitulation actually looks like at the institutional level, how price discovery returns when suppression fails, and why the final phase is never orderly, never widely predicted, and never comfortable for those positioned on the wrong side of history. Capitulation, price discovery, and what happens when suppression finally fails. Every long-running financial suppression ends the same way, not with an announcement, not with an apology, and not with a clear signal that the game is over, but with exhaustion, because no market structure collapses from outrage or exposure alone. It collapses when the cost of maintaining the illusion exceeds the cost of surrender, and that moment is never obvious in real time. This is the phase markets are entering now. Capitulation is widely misunderstood because most people imagine it as a dramatic crash, a single red candle, or a sudden headline announcing failure, but institutional capitulation looks nothing like that. It looks quiet, technical, bureaucratic, and deliberately boring. Because large financial institutions do not panic publicly, they reposition silently, reduce visible exposure, transfer risk off balance sheets, and allow price discovery to occur only after they are no longer on the wrong side of it. In silver, capitulation does not mean everyone becomes bullish at once. It means the dominant suppressors stop defending price levels that once mattered, stop deploying size during thin liquidity, stop absorbing delivery risk, and most importantly, stop believing that paper settlement will always be accepted instead of metal. This is where the meaning of panic selling by institutions like Morgan Stanley must be interpreted correctly, because visible selling does not automatically mean bearish conviction. It can also mean risk migration, moving from leveraged exposure towards structures that do not require daily margin, do not depend on repo markets, and do not expose the institution to delivery failure. When suppression fails, price discovery does not resume smoothly, because markets that have been artificially restrained for years do not gently recalibrate, they gap, overshoot, and destabilize expectations. This is why silver's historical breakouts are never orderly. Bull markets, but violent repricing events that catch both bulls and bears off guard. Once physical demand begins to dominate pricing, futures markets lose control incrementally, not overnight. And this transition phase is where volatility becomes extreme, because paper claims must reprice to reflect scarcity they were never designed to handle. And institutions that once relied on rolling contracts suddenly face counterparties who demand certainty rather than promises. This is also the phase where official narratives break down, because media explanations lag reality, analysts struggle to justify price moves using outdated frameworks, and the public receives contradictory messages. One day, silver is too volatile to own. The next, it is overheated. And then suddenly it is strategically important. But by the time that language shifts, the repricing is already underway. The most dangerous mistake investors make during this phase is assuming that price weakness equals failure, because late-stage suppression often produces the most deceptive price action, sharp sell-offs followed by violent rebounds, engineered volatility designed to exhaust belief, flush weak hands, and discourage participation just as structural pressure reaches its peak. This is why understanding cycles matters more than timing entries, because silver does not reward impatience, it rewards survival. And the people who benefit most from repricing events are not those who perfectly time the bottom, but those who are still positioned when the structure finally breaks. Another critical point is that price discovery does not require universal adoption or mass belief. It only requires that marginal supply becomes unavailable at current prices. And in silver, marginal supply is increasingly constrained by declining mine output, rising industrial demand, geopolitical fragmentation, and national stockpiling priorities that remove metal from open markets permanently. Once this occurs, financial engineering loses power, because leverage cannot create metal that does not exist, and confidence cannot substitute for delivery when physical settlement becomes non-negotiable. This is the moment where silver reasserts its dual identity, not just as an industrial input or speculative asset, but as a settlement instrument, a role it has played repeatedly throughout history whenever trust in paper claims weakens, and that historical memory is embedded not in retail enthusiasm, but in institutional behavior that shifts quietly long before headlines catch up. If the pattern holds, and history suggests it will, the final phase will not be marked by universal agreement that silver was suppressed, but by resignation that it can no longer be controlled. And there is a profound difference between those two outcomes, because control fails before narratives change. When that happens, silver does not need promotion, it does not need marketing, and it does not need belief. It simply reprices to reflect reality. And that repricing tends to be faster than most participants expect, and far more disruptive to portfolios built on assumptions of stability. The deeper lesson in all of this is not about silver alone, but about how modern financial systems behave under stress, because silver is a symptom, not the disease, a pressure gauge rather than the engine. And when that gauge begins to behave erratically, it is signaling that underlying structures are no longer aligned with reality. Whether or not silver ultimately reaches any specific price target is less important than what its behavior reveals about liquidity, leverage, trust, and the limits of financial control. Because markets can be managed, narratives can be shaped, and prices can be influenced, but scarcity cannot be negotiated forever. If this video helped you understand what's really happening, like the video and subscribe to the channel.